I'm often asked, hey Kelly, how does a lender calculate a debt to income ratio? And in lending, we call it a DTI. So today, I'm gonna do a quick down and dirty how a lender calculates a debt ratio. Now realize that the loan program that you're applying for will have a different debt to income ratio calculation or max debt to income ratio. But for now, we're just going to make some assumptions. So we're gonna assume that this is a conventional conforming loan with a 50% max debt to income ratio. So let's say that the usable income for our borrower is $5,000 per month. That's gross income, and that's what we're using from a lending standpoint. Now, I want you to think that at a 50% debt ratio, the maximum that all of that buyer's expenses can be is $2,500, all right? So that's at a 50% debt to income ratio, right? So now, what does that really mean to you? Well, if you want to buy a house, and let's say your estimated monthly payment is $2,000 a month, and that payment would include principal and interest, mortgage insurance, property taxes, homeowners insurance, as well as a homeowner association if you're buying in a community that has one. So let's say for this example that your housing payment is going to be $2,000 per month. Well, this tells you that if your maximum with your total payments, so that's going to include housing, any car payments, credit cards, student loans, alimony, child support, if that maximum that you can have is $2,500 in this scenario, and your house payment is $2,000 a month, then you are left with not being able to exceed $500 a month on your other ancillary debts. So in this case, if you have a car payment that's $450 a month and you have a credit card payment where the minimum payment is, let's say, $30 a month, then you're at $480 a month, which means you're still qualifying at that 50% debt ratio. Now, where it gets off is, let's say that you want to buy a house where your payment's $2,000 a month, but your other debts are $1,000 a month. So maybe that car payment is $700 a month, and maybe your minimum payments on your credit cards are $300 a month. In this scenario, now your monthly expenses are $3,000 a month. If you divide $3,000 into $5,000, you're now at a 70% debt to income ratio. And guess what? You will not qualify, right? So all these other debts are really important when it goes into the home loan equation for debt to income ratio. If you have questions, reach out.